September is historically a month of decline for stock market prices, and this September hasn't been really an exception. The S&P 500 has fallen about 7 percentage points, the Nasdaq 8.5 from the August highs. So, I've been looking in the past days about some possible opportunities for investing and buy some stocks. If you have some cash aside that you don't want it to be devoured by inflation, this video is for you. I'm going to analyze 4 companies. The first 2 are in the so-called more traditional businesses, and the last 2 are tech companies. So the first stock is Coca-Cola. If you look at Coca-Cola year to date, there's a clear underperformance compared to the S&P 500. Coca-Cola is down 11% year to date. What if we look at the S&P 500, the year started about a year. So if we look at the performance of the S&P 500, we can see that it's actually up 14% year to date, which is not the case for Coca-Cola. So there's been a over 20% difference between the two. Coca-Cola is part of the S&P 500 and has some clear point of strength. First one, Coca-Cola is a top holding for the portfolio of the biggest investor in the world, Warren Buffett. It's the 4th investment in his portfolio, and where he owns about 6.6% of his wealth invested in the world. A great plus for Coca-Cola is that it yields dividend yield of 3.29%, which is relatively high. The PE ratio is slightly lower than the tech sector. Somebody could consider it not so cheap. Consider that the perspective of growth are surely lower than the tech sector, so we might compare with other beverage companies, for example, Monster. But if you look at Monster has a PE ratio of 39 against 23. So it's relatively attractive to one of the biggest competitors. Regarding its dividend yield, another thing has to be said. Coca-Cola is a dividend aristocrat, meaning in the past 25 years, it has increased its dividend yield constantly. And something that I love about any company that I like to look at is the net profit margin. Was 22% in 2022, and if you look at quarterly, for the data of the 2 quarters that we have already passed in 2023, we see 28.3% first quarter and 21.2% second quarter. Both quarters are up 6.7 and yet 26.7 compared to the same quarters, first and second, in 2022, last year. The profit margins are higher, revenues are higher, are roughly 5% higher. And the return on capital it's decent, 13%. With a return on asset that's almost 10%. They have positive cash flow. Negative last year, but if you look quarterly, they've done pretty well in both quarters this year. And we can find Coca-Cola. It's traded at a discount. It is the lowest price. We can look here. How much it is lost from its August highs. Roughly 16% from its August highs. And This was in July, 10% from July, guys. So honestly, we can see this clear trend of steady growth that has been continuing since 2012. We're using the 1 week chart. And we've seen strong fundamentals, strong branding all across the world. They're in 200 countries, which make this company make for this company easy to tap into emerging markets. Huge brand. So this is the first buy of the list. The second buy of the list is a company in a completely different sector. It's real estate. The environment for real estate has been hard in the last year because of rising interest rates. Rising interest rates means that mortgage loans require higher debt payments. Therefore, there's lower demand for houses, therefore lower housing prices. DHI Horton is a known construction company. So as soon as demand lowers, there's lower need and lower demand for new houses as well. This company, again, if you look at PE ratio, under 8%. Now, let's compare this PE ratio with competitors in its industry. What are some of these competitors? Well, let's look again at Warren Buffett portfolio. If you look at Warren Buffett portfolio, he bought in July 3 real estate companies. One of these is are Horton, ticker DHI. The other are Lennar Corporation. Doesn't have a PE ratio. Probably is a loss. Dividend yield much lower. It's 1.3 against dividend yields. But actually, dividend yield is just 1%, actually a bit lower. So it's not too exciting for the dividend yield. PE ratio shows to be better than Lennar. What we list. But Lennar year to date has performed 22%. While if we look at DHI year to date is up 19% almost. So just 3% points lower than Lennar. Let's look at profit margins. 2022 profit margins, full year, to do a fuller year data, 17.5. If you look quarterly, just slightly down. 11.8, 13.7. Let's compare with Lennar. Net profit margin, 2022, 13.7. This year, 12.7, 10.8. So they're relatively similar in terms of profit margins. Lennar pays about 0.4% dividend yields higher. In terms of cash flow, they're not very well performing. If we look at DHI, how they're doing in terms of cash flow, they're up. And they were down in 2022. Is now, to be fair, we look at Lennar the yearly, if I remember correctly, yearly cash flow. So let's see if this year they're doing better as well. No, this year in terms of cash flow, DHI is performing better. I know DHI more. You may do your own research and consider Leonard. Just for your own information, Warren Buffett had invested $726.4 million in D.R. Horton in July, while he invested $17 million in Leonard. The second company he invested the most in, Warren Buffett Real Estate, in July this year, 2023, has been NVR Inc. Now, NVR has a higher PE ratio than D.R. Horton, 12, and the profit margins are good, about 6%. So in this case, you can see the return on capital is huge for NVR. It's 13.4% last year. If it continues like this, it's set to outperform the markets. You can see that despite interest rates, this company have performed relatively well. They're all involved in home construction. I know D.R. Horton more, and I feel more confident investing in that. You could, if you're interested in real estate, in terms of investing opportunities in the stock market, you might consider a balance of these three companies in the real estate sector that I've just shown to you, that are all part of Warren Buffett's portfolio. Now, let's go to the tech world. And we start with a classic, and then I will show the most interesting pick for this week that I've chosen. And the classic is Microsoft. Why did I choose Microsoft? Well, if we look at the different profit margins that tech subsectors, like calling like that, like software, semiconductors, internet, IT services, and hardware have, we can see that there's a difference, a huge difference. And taking the tech sector as a whole can be misleading. Indeed, we go from the highest profit margin made in software, which is about 35%, and lowest in hardware, which is about 14%. Now that's a 21% difference in profit margin. Okay, so that's very different. In the middle, you have semiconductors, internet, and IT services. You also have to consider that these sectors are react differently to the economic cycle and the business cycle. For example, hardware and semiconductors are more cyclical. They are really more dependent on current demand levels than others like software and IT services. And the reason is that software and IT services have longer term contracts. These are companies that offer software services or IT services for other companies. And these are contracts that last 5-10 years. So before you actually abandon a contract, takes more time. While hardware, well, if you sell less phones, people buy phones every year, you're gonna soon find out that people are buying less, and you're gonna make soon less money as soon as the economy declines and there are lower savings, as we are seeing right now, by the way. Savings are declining, which is a forward indicator that demand may decline, and not necessarily a recession, but a lower demand may have consequences on the economy. By the way, JP Morgan and UBS forecast a recession by mid 2024 as a result of the higher interest rates. That doesn't mean we're going to have a depression, but that means that this is going to have some effect on the economy and therefore on the stock market as well. So going back to our investment thesis, software is the most interesting. Which one is the most interesting company in and leading company in software? MSFT, the good old Microsoft. Microsoft ain't cheap at all. PE ratio of 32.6%, dividend yield of 101%. The performance year to date has been amazing, 31%. But if we look, we can still find a discount compared to what it was in August. The highest point for Microsoft has been in July, and from there it has lost to its lows yesterday, 14.3%. So we're paying a lower premium for it. And listen, my investment horizon is long term. So for all these companies I'm showing this video, these are not trades that I'm doing for short term speculation. I do believe that these are very high quality companies. I already hold the last two I've been showing. They are Horton and Microsoft, and I'm adding Coca-Cola, which has never been on my portfolio before. So I'm not worried about a further decline that I know can happen. We can expect usually a good quarter for the last part of the year. Normally we have a good performance, but I'm not surprised. So even if you trade it in the short term, you could see some upside. But I do not guarantee and do not advise anybody to invest if you don't in these stocks if you don't have a long-term perspective. By long term, I mean at least 5 years. Okay, so these are money you don't need that you want to invest either because you want to get in the game to learn more. If you want to learn more, by the way, subscribe to this channel. I'm trying to give as much value as possible. And I read your comments. So if you want me to make a special video on something that you're more interested in, tell me. I'll probably execute on that. And so back to our videos, Microsoft has a huge, a very, very good profit margin. I mean, look at this quarter, the last quarter, up 10.7% from last year to a 35.74% margin. It means that every dollar they make, more than a third of it is profit. Just mere cash that they have. And this is proven true also in the longer term if we consider the aggregate of the quarters for last year, 36.69. So the average for this year is 34, slightly lower than next year, but the best quarter still has to come. So we will see. They're on track for a very good performance, return on capital of 21%, and cash flow. I mean, this graph by itself. Let's go to the last. Which one is the last? It's a tech company, as I've told you, and it's in another of these 5 subsectors. It's in the second one. It's a semiconductor company that has been hit particularly by geopolitics. By the time I say it, somebody might figure it out which one am I talking about, and it's of course Taiwan Semiconductor Manufacturing. Taiwan Semiconductor Manufacturing has performed it's up 17.38% year to date. Its P ratio is much lower than its competitors. Its competitors have a P ratio, for example, ASML, Dutch company, which produces the machines to produce semiconductors, has a P ratio of 29.7%. and Broadcom has a PE ratio of 25.4. Taiwan Semiconductor Manufacturing has a PE ratio of 14.45. So much lower than peers. The main reason is geopolitics, of course. China has threatened Taiwan multiple times. The United States have tried to move semiconductor manufacturing plants to the US, and Taiwan Semiconductor is trying to move some of its plants away from Taiwan to the US to keep its market share. Among its biggest clients, you have Apple, just to say the least. And semiconductor manufacturing in general is a sector that is set to really get some big gains by AI development and the whole technological sector, tech sector development. So this is a company that has continuously delivered great results with profit margin that really are unique. About 45% in 2022. It's slightly lower this year. But you can see that they're always about 35%. And they had negative cash flow in the last quarter. So we'll see how they're going to end up. But this company, if we look at it, it's just really a great outlook. It has its geopolitical risk, which is the main thing I would consider if I was you. But I was a little bit underweight on this company. So this is what I'm adding to my semiconductors exposure. This was it for this video. I hope I gave you some insightful perspective on some stocks that have good potential and that high quality companies that are trading at a slight discount compared to last month, and you might have to have them in your portfolio for the long run. With this, I wish you the best. Stay invested.